Grant, welcome back to the show.
Hey, Mark. Thanks for inviting me again.
Glad to have you back on. And you've been doing so many great things, really since I've known you, because you were actually directly responsible for changing my life, my family tree, and more. So we like having Grant on any chance we get. But Grant, you came on last in episode 357. That was July 5th, 2024. So we've had a few things happen in the world and in the markets: wars, elections, tariffs. What's it been like? What are you seeing in the economy? What's happening with your personal financial planning business that you run and your clients today?
Things are going pretty good. People are excited, and we're putting lots of plans together, and what we're doing is working, and it's working very well. And we just put a little more peace in people's life. That's the goal.
Mm-hmm.
People are happy, and they want to know, how do I make my life better, and how do I have a peaceful time while I'm growing to retirement age, and then when I get to that point, how do I make sure it lasts?
Yeah.
I gotta get from now to dead, and then how do I want to leave a legacy? So people are still having those conversations and wanting to have those conversations. But people are still a little nervous to see what's happening out here. There's still a lot of things happening in the world if y'all are watching the news, and not that we want to watch the news.
Mm-hmm. Yep.
but we got to keep up with what's going on. So, but we're feeling pretty good about everything. Companies are doing well, and we're doing very well. We got lots of people very happy. So
I love that. Yeah, you don't want to watch the news. You'd rather be the news, at least at the barbecue, and especially when markets are volatile. You're going to be the news of the neighborhood anyway, maybe not world news, but of your neighborhood barbecue, and you're the only guy who's got a count going up and to the right when the rest of the world, I don't think, no matter what time you're watching or listening to this episode, I'm betting one thing about the economy, about the markets. Here's my prediction. You ready? It's still volatile.
yeah,
It's still volatile, whatever's happening.
Agreed.
So Grant, the reason why I wanted to have you on today and get your input on this, you've been doing this longer than I have by a long shot. I think you actually helped Gutenberg with his printing press, if I remember right.
Yeah.
Okay.
It took a little while to get our buggies over there and get it all done, but we did get it done.
That's right. So no, just joking. But you've been able to help clients go somewhat further down the field, and you and I both have clients that are in retirement, but it just is natural that there's going to be folks when they've worked with you for 25, 30 years plus, whatever. More and more folks are going to be at that stage of life. So what I wanted to talk to you about was, how does Bank on Yourself actually work when we get to that phase of life? So give us some real live examples. Does everybody do the exact same thing with their policies? And I'll just I won't bury the lead. I feel like many times people's retirement plans have one-trick ponies baked inside, and you might have a team. You remember, speaking of buggies, horse and buggy, imagine if all your ponies that were carrying that buggy were one-trick ponies, all running north, south, east, and west in different directions. Your buggy would be pulled and not really moving anywhere. And I feel like people who have their 401k over here, their brokerage account over there, their crypto account still further afield, their old credit cards they still haven't paid off. Maybe they are taking Social Security now, but none of it's actually a dynamic, flexible account that allows them to have choice. They're kind of locked into whatever it is the one-trick pony can do. Tell me about Bank on Yourself clients as they've made it to that point in their golden years, and what it's been like actually using your policies.
In retirement, as I call it, passive income years, because I don't really like that word retirement, because to me it sounds like we go home and die.
Mm-hmm.
Okay, but I prefer the passive income years. But having multiple streams of income, I think, is very important. You may be a person that's really heavy market, and you love the market, and that's great. But markets do this, and if you read reports, white papers, different places, you can learn how's that going to work. So one trick pony, as you said, that's one trick. Okay, I don't want to have everything there, because when it's doing well, okay. If it just went straight like this, that's easy. Just point and click. We're all geniuses, every year, because we know the best things, right? Well, we know that's not how it works. So we like to see multiple things happen. That may be having an annuity. That's your life insurance account, your Bank on Yourself style type plan, how we set those up. That's another source. Your Social Security. A lot of people are nervous still about that. I think the government's going to go default on this thing. I don't think that's going to happen as a default, but there's some things that could cause that to reduce in the future. If you've been listening to the news at all on that kind of thing. But I think you need to have multiple streams, and I think if you're banking yourself type policy, that's a spot to be drawing money from. Could be there for a buffer. You got your annuity income. The big things that you got to have in there is you got to make sure in retirement that you got your guaranteed income in one spot that's going to is going to have that coming in all the time. So that way, doesn't matter what happens out here, you're okay. You can at least pay your bills, and then you can have your multiple streams. Maybe it's some alternative assets. Maybe it's some real estate. Maybe it's horses. Or it's a lot of those one-trick ponies. If you know how to make money with one-trick ponies, go for it.
Mm-hmm.
But it's really about having multiple streams, and I think having the banking yourself, to me, that's the foundation on the house. Okay, it's you've heard it many times. How do you build your house, on the rock or on the sand? And to me, the place that needs to be in the rock is that banking yourself type policy, so you can check off lots of boxes for that.
It's huge.
Because that'll be, as we like to say a lot, the Swiss Army knife. It does a lot of things, but it's not the only thing you need to have. You need to have some of these other vehicles that I was talking about, and if you get those structured right, then even if you're still playing in the market some, you can at least not be afraid if that thing just that part of the house gets knocked down because of whatever happens in the marketplace out there. You're guaranteed never to eat cat food if you will put your plan together correctly, as we like to do it with the different structures of different vehicles. And that way, something doesn't work, you're still okay over here. And so I want something I know I can get into the boat, the motor's going to start, and it's going to go where I'm pointing it. And that gives me a lot of peace in planning. It gives me a lot of peace in my personal, and clients get a lot of peace knowing that they're okay.
Yeah. So. I mean, isn't that kind of what a plan is when when you start where you're going to end? I mean, isn't that what a plan? I mean, that's a roadmap. A GPS usually has a destination in mind. Can you imagine calling it a plan if you had no clue really where you're going to end up? I mean, maybe you've got 1,000 Monte Carlo scenarios of where you might end up, but where are you going to actually end up? Nobody knows. That doesn't sound like anything like a guided real plan. Sure sounds like a recipe for anxiety. But I'm curious, give me some real life examples of how your clients are using their policies now that they're at that golden age. Are they all using it the exact same way? How do you use your policy once you hit the passive income years?
Everybody's a little different spot, but because again, that's why we customize everything, so we can put together the whole strategy of how we're going to take out income. That's what we do. We put it in a whole piece to show you exactly what your life looks like, and where do we take our money most tax efficiently too. Because there's a right way and a wrong way to take our money. The policies itself, we have people that are just drawing money off of there maybe every year. Say I want to take this much off of it, or they might say I want the growth, or I just want the dividends. The thing is, they can take whatever they want with it, and then we've got the other vehicles, annuities, and different things in place for them for income, and then they can do their investments, different things there. But that policy, that's the thing. When things don't work out, that's still going to be there. And the tornado comes through and knocks part of your house down, you still got that foundation built there.
It's huge.
And if you mix that in with an annuity, that's another piece of the foundation, the right kind of annuity. So I think it's important to get all those pieces put together. But yeah, we have people using them different ways, and again, they can take out just a fixed amount. I like it there also for like a buffer asset. So if you are in there still, investing in the market and things, get hammered and you're in income mode, that's a danger spot, right? That 5 years before retirement, 5 years after, y'all have heard of this before, the 10-year danger window. If you have everything in the market and you get hammered, that's a problem. And you can flat out run yourself out of money. So what I do is if I have someone doing quite a bit of that, when we put the income planning together, we show what happens if just given the history of the market, go run through this, inflation hedge it, all those things that you got to make sure you're covering for future. What happens if you just keep doing what you're doing? And if we can make some minor adjustments in there, mix in a policy, mix in an annuity, mix in, the different vehicles, then you can have a better outcome. And you don't have to worry about, am I going to run out of my income? Because that's really what you're trying to do. And I'll give an example in a minute. But you're trying to get from now till dead. Of course, then do you want to leave a legacy? If you still love your family and you want to leave them something, that would be a good thing.
Mm-hmm.
But we want to make sure we get you all the way through with no chances at 82 years old, all of a sudden I'm running out of money because of inflation. I don't know if anybody's heard about inflation.
Yeah.
I mean, I don't know if anybody's noticed it, but, as I was talking to a client the other day, he said, I took my family through the fast food joint. He's got 5 kids plus his wife. He said it cost us $90 to get through there. And I'm like, for fast food driving up.
Mm-hmm. Yeah.
Not saying it wasn't good, but I'm just saying that's expensive. So we've got to make sure that we're building your plan, your strategy, your income, but we need to put a lot of that on the guaranteed level so that's going to be there.
Mm-hmm.
And then all the extra things you're doing investment-wise, that's just going to be bonus on the top. And you can even get a little riskier if you want, as long as you have the basics set up. But that's what I ran the other day for a gentleman. We were going through that, and he had everything in the market. So, but after we put it all together, what we did is we put the whole income plan, showed him how that's going to operate, and showed him how he's going to run out of money at 78 years old. If just, again, we're putting the history in it, we're putting inflation in it, how he's going to run out of money, at a certain age, which I said, are you okay with that? Of course, he said no. I mean, so how do we fix it? We've got a life policy there for safety, security, liquidity, all the other Swiss Army knife things it does. Also, what do? We put an annuity, and a lifetime income annuity with that.
Mm-hmm.
So he moved the pressure. Instead of running out of money at 78, what he did is he ended up moving the pressure over to the insurance company on the annuity. And he had the life policies, the backup, because you still got to have liquidity. You still got to have it. I don't care who you are. So what that did, it took the pressure off his other investments, put more pressure on the insurance company, and then he had this big estate out there. It created a bigger estate for his family. He was able to leave more, leave a better legacy.
Mm-hmm.
So that's a cool thing, and when you're putting the pension together, depending on how you choose that, and Social Security and all these income sources, if you're lucky enough to have a pension, again, there's a right way and the wrong way to do that too. But that's where these, like the life insurance policy, that banking yourself account, the annuities, that puts the stabilizer in the whole thing and gives you permission to really branch out to other things. And when you get out to retirement, I still have people that, I've got one, he said, Grant, I'm just still going. I'm going. He's doing all these different things. Well, he uses his policy still for investment. So he's still
even into his golden years.
Yeah, because he's like, what am I going to do all the time? I've already played all the golf I want to play. I've seen 89 continents. He said, I've done all that. He said, but he still likes doing deals. That's what gets him up in the morning. And because, we're all talking about retirement. Again, I don't like that word, but, you got to have purpose. Because if you don't have purpose at that time, 4 years, you're going to have health problems. 8 years, you're going to be dead.
That's right.
Okay, so I don't know if that sounds like a great retirement to you, but it doesn't to me. So having that proper plan and having that policy there is a good buffer too.
Sure.
At market tanks, you're taking income off of it. I was kind of talking about a minute ago. If you keep taking that income out and the market's down, you're going to run out of money faster.
Yep.
And that's where having a policy can even be a buffer asset, to help take when that thing's down, try to let it come back again. Same way if on an annuity.
If folks want to hear more about this idea of a buffer asset, go back and listen to episode 194, Use the Volatility Buffer Against Market Madness.
There you go.
And you're exactly right, Grant. So you've actually brought up a couple, and I want to even push you even further into this question of, hey, how can we use our policy so that it's not just a one-trick pony? When people hear life insurance, they think, oh, yeah, that's the money I'm going to leave my family when I croak. But you've already told us a couple of totally creative ways to engage the policy into really a cash flow management tool into your passive income years. I'll just name a few of the things I heard you say. You can take occasional chunks of money out to buffer against market volatility. using the buffer asset concept. Again, guys, listen to episode 194 if you want to hear more about that. Yep. You mentioned certainly borrowing against the policy to continue to invest in real estate or alternative assets, that sort of thing. Continuing to grow your nest egg. Even after you retire, you still got to save even after you're, quote unquote, retired. You brought up legacy, leaving your family more than you could ever save for them, because as you said so well once, Grant, the only other way you get wealthier after you die is if you're a famous artist, or have a life insurance policy. So I think this is easier for me knowing the way I paint. Share some other ways in which we might use this policy after we stop paying premiums for it, for example.
Yeah, I think a lot of people hit retirement time and say, okay, I'm just going to take all my money and go spend it now. That's okay. Probably not exactly that way. That's the idea. But, other things happen. Other things you might want to do. You may, let's be negative here for a second. Maybe you do need, everything's healthy today and you go to the doc and you're not tomorrow. Maybe that accelerated death benefit rider or something that's on a policy. These are more of those hybrid policies today, and we can get into long-term care, but people are nervous about long-term care. I'm getting more and more of those conversations, and I'm bringing them up more too and say, what are you doing about that?
Yeah.
$5,000 for assisted living in this town, 5 to 6, full care, 10.
That's per month, right?
Per month. Absolutely. So per month. So that's where, you've got a policy too. You say, well, maybe I don't care as much about the death benefit. Well, how about using that for that? Depending on who you're working with, a lot of times there's no extra premium for that. It's just a benefit, lets you get into your life insurance and use it for long-term care, especially your single folks where you don't have anybody take care of you. So that's a big number.
And it's a big number. And so just to clarify what you just said, Grant, and I want to have you keep going here, but basically, folks, if you've got a picture in your mind, you might have a cash value, let's say at that point, let's say you're 87 years old or 92 years old, your cash value, for sake of example, is $400,000. Your death benefit might be, give us a number there, Grant, what do you say, 600,000 or whatever?
6 to 7, probably.
So it depends on guys, you might have twice that or half that much, but just walk with us here. So your $400,000 of cash value is available for any reason. You can use it to go on a big cruise, or you can fix up your house, or you can spend it as income in retirement. But that death benefit, most people think you got to die to win with that thing. But Grant just said that you can access a lot of it, like almost all of it. What do we want to say, like 85, 90% of it most of the time is a lump sum. And you can get access to it before you pass away. And use it for certain conditions that you might find yourself in, a chronic condition, Alzheimer's needs, long-term care style needs, as long as you meet the criteria, the typical long-term care style definitions. And then you get access with no tax due, because it's a lien that is paid off by the death benefit. A large majority of that money, you might have $500,000+ you can use to help supplement, give you some integrity in your final years, using that rider. And Grant just said there's no cost to that, adding that rider on the policy. Did I say anything that you'd change or update there, Grant?
No, you said it better than I did, so just keep saying it.
No, that's great.
So.
Why doesn't everybody know that's an option?
Because everybody's not always open-minded. A long time ago, I was taught by, my dad and even my wife's dad, they always said, walk through the door and see what's through the door. And if you don't like the door, turn around and walk back out. It's easy, So, sometimes people still get this thing, and it's unfortunately been like this for a long time. People say, well, life insurance is not a good thing. Well, is it? Now term insurance, there's less than 2% of those ever pay a death claim, but, just die once and see if you need it or not. I mean, so it's term is there, and I like term. And then when we mix them into what we do with the whole lives and such, but getting something that you don't have to die to win, that's where the whole life comes in too. Because I don't want something. The only way I get to win is if I die. I want my family taken care of. Don't get me wrong, but I want something that's useful.
It's a lot more fun to spend money while I'm still alive, Grant. I'm just going to go off that assumption.
Okay, you get it. So,
all right.
That's where that life insurance really comes into a play. And yeah, you can tell I'm a big believer because I just paid a claim again the other day. I paid a ton of them because I've been in the business long enough. I've been doing this. And so far, nobody's turned it down. And, they're always glad to see me because that's coming in income tax free. So that's always a good thing.
Yep.
But having it as an asset class, think of it that way. When you know all the benefits of how you can use this, here's this asset class. If you didn't know it was life insurance, would you want it? After you hear all the benefits, who cares what you call it? So it's a stable force. It's where the foundation is set up. And again, it's not going to get in the way with anything else you're doing. In fact, it's going to enhance it. It's going to make it better.
Now, we've had a couple of our clients in those passive income years. They've built up a couple of policies. Maybe they've got 4 or 5 policies, and they say, "Well, Mark, I kind of like these annuities that you're showing me here." Grant, talk to us about how you can take some bank on yourself policies and mix in, actually even move them to an annuity without taxes due.
Yeah, you can. If you say, hey, I need more income or I want to get more guaranteed income, something like that, you could actually go to your policy and you can do a 1035 exchange from a life policy to an annuity for growth and income. You can do lots of there's all kinds of annuities, guys. There's a jillion of them out there. And some I really like, some I don't like that much. And but again, it's the tool. Use the tool right. It's like a hammer. It's a great tool. You can do all kinds of things, but it's terrible for taking nuts off bolts. Don't use it for that. It won't work. You're going to be frustrated. So that's where you can do that and take that over and put it into an annuity. And you can still keep your life policy if you want to do a partial, or if you say, I really don't want that, then you can transfer it over to an annuity, make it lifetime income, or just a growth play if you want. But do it for the right reasons, and don't just make that move real quick without understanding what you're fixing to do. Because once you undo a life policy, if you do the whole thing, you can't make yourself that age again, and that's over. And there's all those extra benefits that we talked about for chronic illness, that kind of thing. So you really want to examine that before you do it. And it also kind of depends on what kind of policy it is. You may be in one that, where the costs are increasing on you out there, and you can call out the name if you want to, Mark, but those might be a good one to consider moving over to an annuity, especially if you're running into
you're talking about universal life, basically.
Yeah. I was being nice, but you can say it. But it's again, what is it you want? What do you want your money to do for you? And to me, it's creating that security for you, that we all want. And if you say, I've got so much money, I don't need it, then let's involve a charity or a church and let's leave it there. I mean, I think that's a good thing to do, too.
I think the Grant Thompson Foundation is accepting donations. Is that right?
Well, I can start one tomorrow if you want.
Just kidding.
No, they wouldn't let me have it.
That's right. So. I know. I'm just joking. So, Grant, you've brought up some really good ones. We could keep going. I mean, what about, imagining people who already have whole life policies and they don't need to spend their Social Security because they have other assets, 401k, IRA, annuities have been set up. They don't need that Social Security. What could they use their policy for in that case?
Oh, hey, great idea. No, that's a great idea. I have those. They're receiving enough income. Really, they don't need their Social Security income. So we have taken that and started policies on them, to leave a better legacy. We've even ran into sometimes that maybe they don't need all their annuity income. We set them up in a good spot. I had one of my family members here recently. He's got all the income, and he said, Grant, I don't need any more income. I'm still sitting with a big chunk of annuity over here that he's not even going to draw on. So now we're thinking about how do we parlay that into a better legacy, or to their church.
So you
or
could
charity.
Keep paying those premiums. Even, let's say my original plan with Grant might have been to stop paying premiums when I'm 65 or whatever. But now Grant, hey, I don't need my Social Security check. I'll take it, thank you. But you're saying continue funding my policy into my later years.
Existing one, that's a great point. Thanks for pointing that out. Existing one, or maybe a new one.
Start a new one
if you're still unsure.
Start a new whole life policy.
Or how about, or even I get a lot of people wanting to do something for their kids.
Yeah, kids.
And that's another way to do that as well.
Great.
Again, how do I take pennies and turn them into dollars? And that's what you're doing with life insurance. and understanding that wealthy people own life insurance.
Mm-hmm.
Wealth creators own life insurance. They understand the power of that once they've been using it. So you have people putting, as you've said many times, Mark, we have people putting millions and millions of dollars in those every year. And so it works as an asset class that is going to help you build your wealth and protect it too. And one more thing there too to think about is, how about your pensions? I had one of this the other day. They're looking at their pension. Well, unfortunately, I caught them after the fact. The pension's already been started. It's a lifetime fixed payout. He dies, a day later after he starts that's the end of it.
Ooh.
Okay. Didn't pick a joint option for his wife. So now we're saying, okay, well, let's put a policy on you so then you still can continue to leave her an income off of that pension by setting up a life policy.
Oh, that's a really smart strategy. So I'll just say again what you already said really well. But basically, this guy, I would hate to hear that conversation. He's probably sleeping on the couch still, but he chose a single life pension, and meaning when he croaks, the income on that pension stops, leaving his wife without any income from that pension. You're right. He could pass away 2 weeks later, God forbid, and she's out that cash. So you're saying take some of his pension income, buy some life insurance with it, so that if he passes away, it can continue on that. We could basically take that giant chunk of money that his wife would get as a death benefit, and then buy an annuity with it or something that would give her some lifetime income.
Well, and when you understand how, not to go deep with this, but how a pension works, if you haven't done that, and you can pick your single or joint life options. When you're doing a joint life option, you're really buying life insurance from the pension. Aren't you? That spread that you're taking less. So why not think about getting your own where you got fully control of the money and still create the same scenario? We call those pension maxes in the day, but it's still relevant today. And I just did one here not too long ago. Oh, and by the way, I just had a client who did pass away. And fortunately, again, this is what happened. She lost part of the pension, still gets part of it for her, but this life insurance came in, boom, replaced the reduction that she got.
Yeah, it's genius.
And
smart.
Same way with Social Security. So even your Social Security benefits, remember, one of you loses it, at times. So why not think about a life insurance policy to replace that Social Security pension to your spouse?
Yeah, that's great.
And so there's lots of ways to cut it up, but that's what life insurance does for you, and it's not a single purpose asset. It's this and
it's not a one-trick pony. Some people say, well, Mark, it's so expensive. And I think to myself, look at all that it's doing for you. Just listen to this whole episode again, guys. Grant gave us count them, maybe a dozen different ways and this is not even talking about the bank on yourself stuff and the pay for kids college and whatever. We're just talking about once we get to those later years when everyone thinks, oh, I should just drop my whole life insurance. I don't need that stuff anymore. The kids are out of the house. My mortgage is paid off. I should just close my policy down. That's like the worst time you could do it. Why? Because the policy's cash value is growing at its most efficient. You've probably paid off most of the costs at that point. You're going to need it for all the reasons that Grant just brought up. I mean, the 10 plus reasons that we talked about today. When you're buying something that does so much, we call it a Swiss Army knife. We called it, think of all the different ways you could think of this. It's built really to be sort of your one-stop shop for, all the different creative ways you can use this into your later years. Anything you'd add? I don't know if there's a question in there, Grant, but anything you'd add to that?
Well, I just want to take another level. What about your estate? So my question is, with all these things, this isn't my quote, but I always remember one of our colleagues in our business saying this. He'd say, is there someone you love so much at the IRS that you just want to send them a bunch of money? So, or do you want to leave all your money to long-term care facilities? That's costing 100 cents on the dollar stuff. And why don't we talk about pennies on the dollar? That's the best way to leverage your money. And why sit there and do that? Because again, we do a lot of estate planning as well, and we just got through going through two, and I'm sitting here looking, he said, well, I'm just going to give all that money I've left this much cash, that's going to pay the estate tax, at 40%. I'm like, you know how much money that is? He goes, yeah. I said, You want another way to do that?
Yeah. Mm.
And so that's where life insurance can come in too, because people that understand this tool and they use it appropriately, it's not an investment, okay? That's not what this is. You got your investments, all these things you're playing with, but remember that life insurance, it will solve and check off a lot of boxes and get you taken care of. Because we don't want to forget, y'all have probably heard this already from Mark, I'm sure many times before, but there's some famous people that use life insurance for things, and Disney, and there's some others out there. But understanding how this tool can work, and in retirement, as Mark was talking about earlier, how to use that, and then if something unforeseen happens, how can that even help you more? I don't know. The more I can use somebody else's money to pay my bills, I think the better. Yeah. And the more I can leave my family, I think is better. Again, I have no asset upon my death that's going to jump up in value just because I stop breathing.
Yep.
Except life insurance.
Yeah. Guys, as you can see, Grant's got a ton of creative ways to approach what you would have once thought to be a boring, old, dusty whole life policy. He's seen and really breathing new life into it, literally. And so I really encourage anybody listening, if you haven't already, listen to what Grant has to say. He's changed my life. So, Grant, I'd happily recommend folks chat with you. What is the best way folks can find you and reach you if they haven't already checked out what you have to offer?
They could go to our website, thompsonthurman.com, and or you can certainly email us, grant@thompsonthurman.com, or you can just give us a call if you still know how to dial a phone, 806-352-3480. And still, we'd love to visit with you and happy to get on a call with you. And, again, walk through a door and see what the door is. And if the door is not what you're supposed to be in, then walk back out. No one's going to pressure you to do anything, but good planning matters. And I'll tell you what, not everybody has all the great ideas out there, but there's a lot of very simple things you can do today to help it. And obviously, Mark, you know it all, so they can call you too. So it works out great.
Well, but you could either get 10, 15 different financial tools that can closely approximate what Grant just went through in today's episode, or you can get a properly structured bank on yourself designed whole life policy that can do it all with a lot less cost, frustration, and not needing like a team of attorneys or investment planners to do it all for you. So check it out, thompsonthurman.com. Thanks, Grant, for coming on today.
Thank you, Mark. I appreciate it so much.